Psychology of Money: Timeless Lessons on Wealth and Happiness by Morgan Housel. Imagine two men, both brilliant, both pioneers in their fields, both amassed immense wealth. One, an executive named Rajat Gupta, soared to the heights of corporate America, becoming a director at Goldman Sachs and Procter & Gamble. He had it all: power, prestige, and a fortune that most could only dream of. Yet, he risked it all and lost it all to satisfy a seemingly insatiable desire for more. He ended up in prison for insider trading, his reputation shattered. Then consider another, a seemingly ordinary janitor named Ronald Read. For 60 years, he faithfully cleaned floors and worked at a local J.C. Penney. He drove a modest Toyota Camry, wore old clothes, and lived simply. When he died at 92, people were stunned to discover he had quietly accumulated an $8 million fortune, most of which he bequeathed to hospitals and libraries. Two lives, vastly different outcomes, yet both revolved around money. One sought it aggressively, seemingly never having enough. The other, almost unknowingly, allowed it to compound through patience and frugality. What's the hidden lesson here? It's not about how smart you are or how much you earn, but how you behave with money. And that, my friends, is the cornerstone of Morgan Housel's groundbreaking book, The Psychology of Money. As traders, we obsess over charts, indicators, and economic data. We analyze, predict, and execute with lightning speed. But what if I told you that the biggest blind spot in your trading strategy isn't on a technical chart, but within your own mind? It's about understanding the irrational, emotional, and often counterintuitive forces that drive our financial decisions. Today, we're diving deep into the psychology of money to uncover the most vital lessons that can transform not just your trading performance, but your entire relationship with wealth. We'll explore why intelligence often fails where patience succeeds, why enough is a magic number, and why understanding history is more important than predicting the future. Get ready to rethink everything you thought you knew about money. Lesson number 1. No one is crazy. Our childhood experience influences. When we see someone make a financial decision that seems utterly irrational to us, whether it's an investor holding on to a losing stock or a speculator taking on excessive risk, we often label them as foolish or irrational. But Housel argues that everyone makes financial decisions based on their unique experiences and the information available to them at that moment. Think about a trader who started their career in the dot-com bubble of the late 90s. They witnessed technology stocks soaring to unimaginable heights, with little regard for traditional metrics. Their experience taught them that aggressive growth and high risk could lead to immense rewards. Now, fast forward to today. That same trader might see a new tech frenzy and be more inclined to jump in, even if the underlying fundamentals are shaky. Their past experience, while valid for them, might lead to a different conclusion than someone who started trading in the post-2008 recession, where caution and value investing became paramount. People who grew up during the Great Depression often harbored a lifelong aversion to debt and a profound sense of frugality, even if they later became wealthy. Their financial normal was shaped by scarcity and hardship. Contrast this with someone who grew up during a period of sustained economic boom, with easy access to credit and a culture of consumption. Their normal is entirely different. As traders, this means recognizing our own biases. Our normal market conditions, whether we thrived during bull runs survived bear markets, or navigated periods of high volatility, heavily influence our current risk tolerance and decision-making. Don't judge another trader's irrational move without understanding their context. More importantly, understand your own context and how it shapes your perception of risk and reward. This self-awareness is your first line of defense against cognitive biases. Lesson 2. Luck and risk, the unseen forces. This next lesson is particularly humbling for traders who often attribute success purely to skill, the intertwined roles of luck and risk. Housel argues that outcomes in life, especially in finance, are rarely 100% determined by effort or skill. Luck plays a far greater role than we acknowledge, and risk is simply luck's flip side. The chance that something good or bad, beyond our control, will happen. He uses the compelling example of Bill Gates, undeniably brilliant, visionary, and hardworking. But Gates was incredibly lucky to have access to a computer in high school in the 1960s, a privilege virtually unheard of at the time. He was also lucky to be born at the precise moment when the personal computer revolution was about to explode. Would he have been as successful without these strokes of luck? It's impossible to say, but it certainly demonstrates that even the most brilliant minds benefit from fortunate circumstances. Conversely, consider the immense risk faced by businesses and traders, even when all the right decisions are made. A company could develop a groundbreaking product, but a sudden shift in consumer preferences, an unforeseen competitor, or a global pandemic could derail it. A trader could have an impeccably researched trade, but a black swan event, a sudden, unpredictable market crash, could wipe out their capital. Acknowledge the role of luck in your wins and the presence of risk in your losses. Don't attribute every success solely to your genius, and don't beat yourself up entirely for every loss. Instead, build a margin of safety. Don't risk everything on one trade. Diversify. Focus on process. Forget about present outcomes. You may need them for data, not judgments. If your process is sound, consistent, and accounts for risk, then good outcomes will eventually follow, even if individual trades don't always pan out due to bad luck. Recognize the survivor bias. We often study the incredibly successful individuals in any field we are interested in and try to emulate them, forgetting that countless others with similar skills and efforts failed due to bad luck. Their stories aren't told. Lesson 3. Never enough. The ceiling of wealth. This is perhaps the most profound lesson for anyone striving for financial freedom, and especially for traders constantly chasing bigger profits. The concept of never enough. Housel argues that the hardest financial skill is getting the goalpost to stop moving. For many, wealth isn't about achieving a certain lifestyle. It's a social comparison, an endless race against others. Think back to Rajat Gupta. What could possibly drive a man with hundreds of millions of dollars to risk it all for a few more million? The answer often lies in the desire for more than what others have, or simply the inability to define a point where they say, "This is enough." Housel illustrates this with a poignant example of Bernie Madoff, who ran one of the largest Ponzi schemes in history. Madoff had ample wealth from legitimate businesses. Yet, he continued the fraudulent scheme, eventually defrauding thousands of investors of billions. Why? Because for Madoff, it wasn't about a specific monetary goal. It was about maintaining an image, a perceived status, and perhaps the thrill of the game itself, constantly needing to be more successful than he already was. He lacked the internal enough switch. This is a trap many traders fall into. You hit a profit target, make a significant profit, and instead of taking some off the table or reducing risk, you immediately set a higher target. The market is a relentless proving ground, and it can feed this never enough mentality. How to combat this? Define your enough. What is your actual financial goal? Is it a certain income, a specific net worth, or the ability to achieve financial independence? Once you hit it, or are on track, acknowledge it. Avoid social comparison. Your trading journey is unique. Don't compare your portfolio size or trading profits to others on social media or in trading forums. This is a losing game. Protect your downside. Housel emphasizes that the ability to survive is the most important financial skill. If you're constantly chasing more, you expose yourself to greater risk, potentially losing everything you've worked for. Setting an enough helps you protect your capital and live to trade another day. Lesson 4. Room for error. The margin of safety. One of the most counterintuitive yet powerful lessons in the book, especially for traders, is the concept of room for error, or what is traditionally known as a margin of safety. Housel argues that the world is inherently unpredictable, and planning for perfection is a recipe for disaster. We need buffers, slack, and flexibility in our financial lives because things will go wrong eventually. He cites the example of the Titanic. It was designed to be unsinkable with 16 watertight compartments. The engineers were so confident that they neglected to install enough lifeboats for everyone on board. When an unforeseen black swan event, hitting an iceberg, occurred, the lack of a sufficient margin of safety led to catastrophic loss of life. The problem wasn't the compartments. It was the assumption of perfection and the absence of a backup plan for the unexpected. For traders, this translates directly to risk management. Position sizing. Never put all your capital into one trade, no matter how confident you are. Stop losses. Non-negotiable. They are your financial lifeboats. Cash reserves. Having a significant cash buffer outside your trading account provides peace of mind and allows you to capitalize on opportunities during market downturns, or simply absorb unexpected personal expenses without having to liquidate positions at a loss. Diversification. Don't put all your eggs in one basket. Spread your risk across different asset classes, sectors, or even trading strategies. Don't aim for the highest possible return at all times. Aim for a good enough return with a high probability of survival. The compounding power of consistent, sustained returns over a long period, even if those returns aren't astronomical, will always outperform erratic, high-risk strategies that eventually blow up. Survival is the ultimate goal. Lesson 5. Getting wealthy versus staying wealthy. Survival focus. This is perhaps the most crucial distinction Housel makes, and it's particularly vital for traders. Getting wealthy often involves taking risks, being optimistic, and seizing opportunities. Staying wealthy, however, is an entirely different game. It requires patience, paranoia, and a deep understanding that what made you money in the past might be the very thing that destroys your wealth in the future. He gives the powerful example of Jesse Livermore, one of the greatest stock market speculators of all time. Livermore made and lost fortunes multiple times during his career. He amassed millions, became incredibly wealthy, but his inability to stay wealthy, his consistent overconfidence, and unwillingness to accept enough eventually led to his financial ruin and ultimately his tragic death by suicide. He mastered the art of getting wealthy, but utterly failed at staying wealthy. Contrast this with someone like Warren Buffett, whose wealth accumulation has been a slow, consistent grind for over 6 decades. Buffett's genius isn't just in picking great companies, it's in his unparalleled ability to avoid catastrophic mistakes, his patience, and his unwavering commitment to a long-term, low-risk strategy. He understands that compounding works best when it's uninterrupted. For traders, this means risk management is paramount. This isn't just a technical skill, it's a psychological discipline. Your job isn't just to make money, it's to not lose money, especially significant amounts. Humility. The market will humble you. Never get too arrogant after a string of wins. The moment you believe you've figured it out is often when the market delivers its harshest lessons. Focus on longevity. Don't aim to be a millionaire overnight. Aim to be a successful, consistent trader for decades. This shift in mindset from get rich quick to get rich slow and surely will fundamentally alter your decision-making. Cash is king. In trading, having liquidity means you can weather storms and seize opportunities. It's the ultimate margin of safety for staying in the game. Lesson 6. Freedom is the highest dividend, the true purpose of money. We often chase wealth for its own sake or for the material possessions it can buy. But Housel offers a different perspective. The highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today. Money's greatest intrinsic value is its ability to give you control over your time. He shares the powerful observation that while people want to be richer, they don't necessarily want to work harder. They want to be richer so they can do less of what they don't want to do. That's the core of financial independence, the freedom to choose. Consider a trader who spends hours glued to charts, stressed, anxious, missing out on family time, hobbies, and life experiences, all in the pursuit of more money. Is that truly wealthy? Now consider a trader who has carefully built a robust system, diversified their income, and established boundaries, allowing them to step away from the screens, enjoy life, and still have their money working for them. Who is truly richer? For traders, this means define your why. Why are you trading? Is it purely for financial gain, or is it to achieve a certain lifestyle, freedom, or purpose? Keeping your why front and center can guide your decisions and prevent you from falling into the never enough trap. Balance your life. Don't let trading consume you. Burnout is real. A healthy, balanced life often leads to better decision-making, even in high-pressure environments like trading. Financial independence is the goal, not just accumulation. Instead of just measuring your net worth, measure your freedom units. How many days, months, or years could you live comfortably without actively working? This shifts the focus from endless accumulation to sustainable independence. The Psychology of Money isn't a book about how to pick stocks or time the market. It's a profound exploration of human behavior and its undeniable impact on our financial lives. These lessons are not just philosophical insights. They are actionable principles that can dramatically improve our performance and well-being. Remember, no one is crazy. Understand your biases and the unique experiences that shape your financial decisions. Luck and risk are ever present. Build a margin of safety and focus on process, not just outcomes. Enough is a magic number. Define your goals and resist the endless chase. Room for error is essential. Always have a buffer. because the unexpected will happen. Staying wealthy is harder than getting wealthy. Prioritize survival and humility above all else. Freedom is the highest dividend. Use money to buy yourself control over your time. The most powerful tool in your trading arsenal isn't a complex algorithm or a groundbreaking indicator. It's your mind, your emotions, and your understanding of human nature, including your own. Master the psychology of money, and you'll not only become a better trader, but you'll also build a richer, more fulfilling life. If you found these insights valuable, smash that like button, subscribe for more content on mastering your trading mindset, and let me know in the comments below. Which of these lessons resonated with you the most? And what's your definition of enough? Love you and love trading. Thank you.